everyone, this is Amit Pabari, founder and managing director of CR Forex. Most asked question by all exporters was why did rupee appreciated from 83.34 levels to 83? So to answer that, there are two parts. One, on the global front, Fed was very dovish in their stance, because of which dollar index have fallen and 10-year treasury yield have fallen. On the domestic side, we have seen flows of FTSE rebalancing, Adani ka inflows there, and our trade deficit also came lower. Apart from that, we have observed that RBI was missing at lower levels for buying dollar rupee pair. Now let us discuss outlook for rupee. Before doing that, let me show you an interesting data point. If you see the table, you will observe that crude oil has fallen by 24% between October till December. Dollar index has fallen by 5%. Both Chinese and Japanese currency have also appreciated. But if you see rupee was relatively stable. So based on this data point, we can conclude that 83.40 is going to act as a very strong resistance for the pair, and if 83 is taken out on a medium to long term basis, we can expect that the pair should move towards 82.5 to 82.20 kind of a level. Now let us understand near term view. On 15th December, which is on Friday, the pair traded below 83 levels for the first time since 48 trading sessions, which is clearly showing that 83 is going to act as a very strong support. On Monday morning, the pair can take support at 83 and can bounce back towards 83.15 to 83.25 kind of a level. But the important point to note is that all fundamental factors are suggesting that rally should be used by an exporter to sell, because eventually we are expecting the pair to break 83 ka support and move towards 82.5 to 82.20 kind of a level in coming days. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. We have advised a lot of thin margin exporters that they should cover 80 to 100% between 83.15 to 83.30 kind of a level. Lot of them have covered the same. If someone has missed, the strategy remains the same, that between 83 to 83.20 kind of a level, they should cover back to back 100%. If someone wants to wait, they should keep a strict stop loss of 83. Now there are few key takeaways for thin margin exporters. If someone has missed covering at higher level, then they should keep a strict stop loss of 83. That is key takeaway number 1. Key takeaway number 2, what kind of costing you can take? Conservatively, you can take 82.75, aggressive 83. Should we do extra booking? Yes, we can do that extra booking between 83.10 to 83.30 kind of a level. What percentage of your total turnover you should do an extra booking? Maximum 5% of your entire year turnover. So for example, if you're a 100 crore company, then you can do 5% of your entire turnover. Which forward contract you should book? You should do exactly 1 year ka booking. So close to 84.50 ka rate you will get. Now let us discuss strategy for thick margin exporters like textile exporters or engineering exporters. Lot of thick margin exporters have one common question which they have asked on Friday and Saturday. What kind of hedge ratio we should maintain? To them, my simple suggestion is that if you are covering on a confirmed order basis, then ideally you should cover 80 to 100% of your exposure. If you are covering on an anticipation basis, then you should take the hedge ratio close to 55 to 60%. And now what level they should cover? If they have covered at 83.30, okay. If they have missed the bus, then ideally between 83 to 83.25 kind of a level, they should maintain this kind of a ratio. Stop loss level, what they have to keep is 82.90. The second question what they have asked is whether to pre-utilize the existing forward contract. The simple answer is no, as we are expecting the rupee to appreciate towards 82.5 and 82.20 kind of levels. Now let us discuss strategy for importers. For importers, Year of 2022 was just like playing a T20 match. Just like in the T20 match, you have to score run at the faster pace and you have to score run in every delivery. Just like that, importers were suggested to cover their imports at a faster rate, and every open imports we suggested them to cover. 2023 was a year where importers were suggested to play one-day cricket, hit the bad balls and defend the good ones. Whenever rupee came near 81, 80 or 82, we suggested them to cover imports for a couple of months, and whenever rupee went to 83, we told them just to defend and cover only near-term imports. In the year 2024, importers should hedge their imports just like playing a test match. Take time on the crease, play it on ease. Importers should follow the same strategy. Do not rush to cover your imports, only cover short-term and near-term imports. Cover imports for next 15 days, 50% of that between 83 to 83, 10 kind of levels. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.